now our panel discussion of practitioners, moderated by Charles-Antoine Leunen, partner at Linklaters. And I will let him introduce our eminent panel of practitioners. I've just been informed that Thomas Leysen will not make it.
I'll give a word of explanation.
Okay.
Very good.
Just let me.
So welcome to all of you to this final session, which is a panel discussion. And when Tom asked us to moderate it, the idea was to put some factual evidence in front of you after a couple of sessions where you looked at some data, and to also put some faces on the data. And to do that, we put together a panel of very eminent board members, if I can describe them that way. And I'll introduce them to you in a minute. There's one missing. He sent me a text message 20 minutes ago with a picture, I have to say, of a flat tire. And so it's the more local person from Antwerp, Thomas Leysen, who unfortunately won't be here, but he sends his regards from next to his car. Anyway, so by way of introduction, starting in alphabetical order with Rika Coppens. Rika, for the Belgians among you, know that she has been elected as CEO of the Year. She's also combining both a private equity background, if I can call it background, because the company that she's running is backed by private equity. And at the same time, she's also an independent director at listed companies, including Colruyt and Euronext in particular. Hilde Laga is the chair of Gimv, and I'd like to thank Gimv again for the support today in organizing this seminar. She's a director in, and I'm not going to name them all, but quite a number of listed companies. She's also a former professor of law. But interestingly, in the preparation, she mentioned, and I like that statement, that you had sort of quit the law to focus on board memberships only, which you think is a healthier approach to being a board member. And then finally, Boel, CEO of Sofina, and also in that capacity member of quite a number of boards, and so very familiar also with the way boards operate, and look at this, and this brings me back to the theme, look at the theme of short-termism. So I'd like to start this session perhaps with asking them, each of them, to see to what extent in the boardroom you have been confronted with a decision or multiple decisions where you had to confront the short-term decision or the short-term effects with the longer-term effects, because we talked about quite a number of theoretical approaches to short-termism and longer-termism. But I was wondering in the decision-making itself, to what extent some of these elements and some of these perspectives had played a role in your decision-making and how you went about it. I don't know, Hilde, if you want to start with that.
Yes, of course. Thank you very much, firstly, to invite me to this prestigious event. But as you heard, it's mainly because we are the sponsor of this event, and the legal counsel of Gimv is there, Edmund. He did it. And then I think it's a very good long-term investment, actually, because enhancing governance discussions on governance, I'm sure, is in the interest of society, of stakeholders at large. But two examples, and you said, Charles-Henri, concrete examples, not easy, of short-term versus long-term I experienced. And I can think of two examples, one in the context of private equity, which is a bit normal, and the other in the context of shareholder activism. Perhaps background on Gimv, we are a private equity firm listed on Euronext. We have a reference shareholder with most of our listed companies, but it's a bit a special one. It's the government, the Flemish government. You know, for the foreigners, we have two parts in Belgium. We have Walloon and Flanders. It's the Flanders government, and they have a stake, and you will correct me, I know somewhere between 27, 28. The rest is free float. So they are the majority shareholder and they control, in fact, Gimv. We invest in medium and small and medium-sized companies, and mostly through majority investments. We prefer that, or we can also be minority shareholders. And now I'm coming to the subject. We typically divest after a period of 3 to 7 years, which is quite common practice in the private equity world. And why is that? That's the question. Well, there are several reasons for that, and some of them, you know them. First is, of course, the expectations of our shareholders, of our investors. They want return, they want dividends, and that's the only way we can generate profits, we can generate cash flows, is selling our portfolio companies. We have the expectations of our managers, very important. We want them to stay motivated, and they receive, in that respect, they receive carried interest, which is a share of the profits. Carried interest, a well-known type of compensation in private equity world. And we consider this, we consider this from a board level as a very powerful incentive to generate higher profits, and in that way the interests of the company, of the shareholders, investors, and the management are aligned. But the flip side of that type of compensation is that, and I try to be nuanced, Edmond, but the flip side of this type of compensation is that there is a chance sometimes that it creates pressure to sell a portfolio company while its long-time potential is not being fully realized. So, to say it boldly, that we sell too early. That's for me, let's say, a bit of a tension between short-term and long-term. How do we resolve that? For us, of course, the interest of the portfolio company is prevailing. Sometimes complex discussions on this on board level, but we always solve it. And we need to strike there the right balance. But, and we are an evergreen fund, we are not a closed-end fund, we are an evergreen fund, we can be patient and wait for shareholder return at the right moment. And that differentiates us from activist shareholders, funds that really go for the short term. Although I read in the recent last, I think, edition of The Economist that the author explains how beneficial short-term shareholder activism can be for the company. You should read it. Can be an inspiration. So that differentiates us from these short-term acting shareholders funds, and that's my second example. At the time, I'm not anymore, I was an independent director in a very well-known listed technology firm, and let me state it like this: our short price and our financial results were not what investors expected. We kind of deceived, not 1 year, but several years in a row, the investors. So one day, these things happened. We got a nice letter from a activist shareholder, a fund, a foreign fund, and asking for 2 board mandates. I remember very well the very lively discussions we had. I said, well, at the end of the day, I acted, I thought as a lawyer, they will have enough shares, they will act in concert to force the General Assembly to vote them as directors. But that was not the kind of discussion my colleagues wanted to have, and they were right. They said, is this short-termism? Do we favor short-termism, or are we going for the long-term with the strategy of our management. And finally, we accepted them, both of them, in the board. It was really very hard for my colleagues. And they thought, what signal do we give to the market? We really are a bit of, we are really concerned. And but to make a long story short, it all ended well, like in the fairy tales, I should say. And because these activist shareholder, they realized very quickly that the fastest way to raise the share price was to stay there for the longer term and to embrace the long-term strategy of the management. So not all activist shareholders are in for the short. So that are my two examples.
Very good example. Thank you for the fairy tale in particular. Rika, in your experience.
Yeah. So I have the benefit of having quite some different companies I'm in. The company House of HR, where I'm CEO, is private equity owned. So I would almost say by definition, you could say private equity is maybe short-termism. But I think there, sometimes we do have those discussions where we are in the boardroom, where we, of course, target an exit date. And some decisions you can clearly feel from the private equity fund that they are targeting a particular exit date, and après nous le début, like they say in French. So after us may hell come. And that is not what we want to be for. So that is requires a management team, in my opinion, that really counters those kind of ideas and says, okay, but we are here for the long term, and the company is more than just the shareholders, in my opinion. It is also other stakeholders, not in the least the employees, and especially in the case of House of HR, where we employ 70,000 people. So I believe, indeed, we also need to represent those stakeholders and think in the longer run for everyone. In order to accomplish that, in House of HR, even though we are not listed, we have 700 employees that are also shareholders. So therefore, we have also, and that represents about 25% of the shares. So that allows us to really take longer term decisions as a whole and as a group of 700 employee shareholders, thinking about next generation, thinking about succession planning, which is also now a board topic. But it does come to the board agenda that sometimes decisions are there to look at what should we do when we get closer to an exit date and what would be beneficial for an exit. So it is a very nice and fruitful discussion to make sure interests are allowed. The other experience I have are as a board member also in family-owned businesses. And obviously there you would say by definition, those have longer term ideas. And especially I think in the case of the family businesses that I have the chance to be as an independent board member, I see that they have really well structured the family. So it's not individuals of the family that are part of those family businesses, but they have structured it in a foundation. There are also governance rules in those foundations that govern the family. And I believe that is indeed a very good way to allow for longer term decisions. So I can clearly see that there the benefit is about thinking about future generations. Also with some good examples of where they involve the fourth or fifth or sixth generation, younger people between 15 to 25 in what they call the future council of the company to discuss what would you like as a future shareholder of this company, what would you like this company to represent for the next generations. So I believe those are really good examples of how you can bring long-term decisions into boards. And I think it's also something that we could bring in companies that are even listed. And maybe as a side remark on listed companies, I always hear that those are companies with public interest. I do have questions around public. How public are publicly listed companies, given that more and more we are dealing with professional investors. I'm also not going to launch the dark versus lit discussion in terms of trading, where professional investors are very much benefiting from how listing is going. And then that being said, and I think Hilde's example of the two board members that kind of came. I think sometimes investors looking at companies, they look at companies, and I always say, not being hindered by any knowledge. So they do not have the full picture of what a company is. They don't see the full picture of what the company is facing. And once, of course, they enter a boardroom and they get more knowledge about what the issues are, what the pros and cons are of certain decisions, I think they also start to see why certain decisions are being made. So I think that indeed having investors lead the discussion on what should there be in terms of reporting and what should there be, I think is the wrong thing. We should look at what is the best for the company and not at what investors are wanting. And I think this is indeed something that, of course, is very difficult because, of course, you need the investors to provide you with the funds and you need them to invest in the companies. But at the same time, you also need to make sure investors can decide what they should decide on and not more.
Quite a lot of themes in what you said, Rika, and not surprised by some of the comments that you've made. I think just listening, if you will talk about the stakeholders and the importance of stakeholders in a few minutes. I'd like to come back on the concept of family and reference shareholder because in the Belgian context that's a really important one, and I think that's something that we'll dive into in a few minutes as well. Your point about the public interest and public companies and the investor dialogue is a really interesting concept that we'll look into as well in a few minutes in some more detail. But Harold, perhaps from your perspective, noting, and should have said this in the introduction, the tagline of Sofina is purpose and patience. So the obvious investor with some patience, at least, is Sofina. From your perspective, how are you managing the short term versus the long term?
Well, thank you, Charles-Antoine. The issues we confronted with, and I'm confronted with as board members, are more often issues of alignment and disalignment, as they are of issues of short-term versus long-term. I.e., I have been confronted a number of times with issues of management pushing for heavy acquisitions, for instance, or for very ambitious investment plan. And board members scratching themselves behind the head to say, okay, when is the cash ever coming back? And then you scratch further and you talk to your colleagues on the REMCO and you realize that actually their incentive is driven on EBITDA. And then you have a discussion at the board and to say, maybe given the fact that we're a little bit ROCE challenged, we should put one of those. And then all of a sudden, management starts, putting up action plans to have a look at the efficiency of their working capital. So that sort of tensions, and it's not so much short-term, long-term, because you can argue, well, you should be doing that acquisition because strategically it makes sense. Yes, but you have to make sure that the incentives of everybody are aligned. And that's one that I see more often, because I think by the time, these are competitive markets. By the time issues come back to the board, the obvious ones, the obvious short-term pain, long-term gain, the obvious low-hanging short-term fruits have been plucked. That's operational job. They've done the job. There's very little short-term good or bad things left to do. The real issues are more of judgment issues around the buy, build, or borrow kind of thing. Should we do it ourselves? Should we buy our competitors and that kind of thing? So we have real substantive discussions. But to come back on, as a second illustration, on Hilde's point, and Sofina, for those of you that don't know, is a long-term minority growth-focused investor. So we take participations in other companies and we help them grow from reasonably early stage all the way to their maturity. And the issue of when to sell is something we've been confronted with. Because there is indeed the notion that, well, it's by selling that you actually generate the profits, and generate the cash you need to reinvest, because like you, we only reinvest our own capital. And we felt there was a potential for disalignment, because indeed the traditional private equity model is that the share that accrues to management only goes to management when the asset is actually being sold. And that creates a pressure for selling. And understandably so, because sometimes managers had to, borrow money to be able to invest in their part of the carried interest scheme and so on and so forth. What we have done is that in order to create better alignment, we have structured our long-term incentive plan on the evolution of NAV, of sort of net asset value of the portfolio, regardless of realizations. So the management, and it's done on a rolling 4-year basis, and we compare the return on NAV on those 4 years against the benchmark. If it's above the benchmark, then there is a fixed proportion that accrues to management on a not realized basis, which meant, and again, alignment and then being, very, very consequent and thinking through the issue. We've always also put a very robust NAV valuation procedure in place, where we actually invite the audit committee to witness line by line how we value twice a year all the companies in the book. And secondly, that we have an independent, and it's a reasonably expensive undertaking, but we invite a third-party consultant to whom we give the data, and then they do their own work, and we compare their range of valuation with the ones we have. So just to make sure also to our shareholders that the NAV that comes out is robust and as conservative as is allowed under the notion of fair market values. So these two examples to say, board, short-term, long-term. What it's really, the more general comment that I had on this question was to say, it's a question of a shareholder is also an investor, and an investor has a horizon. It can be short, it can be long. The idea is that the horizon that he has better be aligned with the horizon in private companies. A reasonably easy thing to do, because you can align yourself. So we're going to do this, and that, and then we can either sell the company, or we can list it, or if it's a public company, you can define a number of milestones on the length of which you will realize your investment thesis. And I don't think there's right or wrong. It's, if as an investor you find some low-hanging fruits in the company, and that's what activists do. They're looking for a 20% bump in the money they made, and they do that on a 3-month basis, and they do that often enough. At the end of the year, they will have a very nice return. It's their agenda, and then all of the luck to them on getting in right with very little unhindered by knowledge. Unhindered by knowledge. You compare that to pension funds, and especially pension funds that are in the building phase, and most Canadian pension funds, one of the leading investors globally, are in a phase where the first moment when they will have to start paying out net between and the outlays is probably later this decade. And so if their management teams come back with a 6-month-long investment thesis, they're shown the door. They say, listen, we're not interested in taking again the same risk over 6 months. One of these days we're going to get it wrong and we're going to lose our equity. We're interested in a 10-year thesis. And so what I think is important is to realize and to sort of appreciate in the discussion short-term, long-term, that the investors themselves probably represent a variety of horizons and probably have for themselves a portfolio of investment horizon. What is then important for the board is to realize that and to align that. So there is, even in quoted company, a work of then communication, of that the shareholders understand that their business is embarked on a rolling up an industry or on seizing new opportunities. And these are things which are going to take a long time to sort of materialize. And they need to have that information, and they need to have that strategic clarity to the market. It's not an easy exercise, because then you start giving information to investors, and the next thing you know, they want more. But so you have to find the right balance there. But if you manage to create that alignment between the agenda of your investors and your own agenda, I think then the tension points around short-term and long-term then get pretty easy to resolve.
Thank you very much. I think what is interesting in what all three of you have indicated is the difficulty of aligning the concepts of short-term versus long-term, but that there's moments in the life of the company and in your decisions where these two concepts come together and where choices need to be made, which is interesting. One point that was touched upon is the concept of a reference shareholder or a controlling shareholder, and in particular in the domestic market that we have in Belgium, the families. In your view, it is often said that families are there to support the longer term view. And I wanted to hear from all three of you whether you think that is an accurate description of a situation.
My experience is that as long as the founder is there and is at the helm of the company, the long term will prevail. But as from the second generation and especially third generation, and you have a distinction between active family members and passive family members, then it's becoming a real challenge to manage the family. And then these passive family members, they get suspicious, they want dividends, it's not in the culture to pay dividends, they want to sell, the founder finds this an insult. They want information, they think there is a lot of information they don't have, they get suspicious, and there is growing pressure and tension within the family. And as a lawyer, and I'm sure you experienced this, it was one of my specialties. It's well, as a consultant, you're often confronted with very, very emotional situations that have nothing to do with the business, and still you have to manage this. And I think, and Harold, perhaps you can further elaborate on this, because you're an example of a family who succeeded in sustainable family business, only if you can manage that distinction, and you need very wise people, then the long term will prevail, and ultimately the company will grow and will not be strange.
Harold, do you want to react to that?
Yeah. Thank you, Hilde. I've met a number of founders, and I still do. And it is not a given that when the founder's in charge, all will be well. You don't get to found a successful business if you don't have a very strong character, and that comes with a certain baggage. And you have people who, having achieved what they wanted to do, grow to the next stage and are into building a legacy. And you have people whose energy, we're getting into two-bit psychology here, but whose energy comes from a floor so deep and something so deep and so strong that it's always about them, and it's never going to be about anything else than about them. And those businesses usually hit the wall because of the inability of the founder at a given moment to build a legacy. And it can be of the moment of the normal age or the normal period for retirement, but it can also be at some point you can be a fantastic operator, you can be a fantastic tactician, and a lousy strategist. And it's at that moment that the really good founders, be it in their 30s, in their 40s, in their 50s, whatever, hand it over and create something and create something else. So I would tend to challenge the fact that as long as the founder's in charge, it's always going to be well. That being said, once you pass that first generation and you've passed over the first hurdle, you get to the second generation, where the strength of the family is going to be dependent on how much of the original culture, the original drive of the founder is still there and kept together. And that's usually, numbers of people within one hand. You get to the third generation, you are starting to get in 20-ish sort of people who are really important. And there, at that moment, the what's at stake and what we have found, we have transitioned our family business from generation 4 to generation 5, which is mine. And so generation 6 is around the corner. And what we did from 4 to 5 was to build an institution. So to change, whereas in previous generations, big decisions were being made by conversation, bilateral conversation, half a dozen of them between the people who mattered and who had the trust of the other ones, to having explicit conversations in explicit settings with rule books or principles. What does it mean for us? We are the controlling shareholder of Sofina. What does it mean? What is our job? And what is the job of the board of Sofina? And let's define that extremely well. Once you've done that, then you are in safer waters in the sense that by that time you have a shareholder base numbering in the 100 or in the hundreds, depending on how many, depending on the demography, which means that obviously people, they're like anybody else. Sometimes they have issues, sometimes they have problems, and sometimes their personal problems spill into the family business. But their share of the total votes and their share of the total governments is limited enough that you can actually deal with it in the same way that you deal with, because sometimes it's a good idea to have them on board because they come with different angles. But if you build that institution, if you're there, then it's a question more of making sure the institution stays alive, making sure people stay engaged. And you only have limited spots within the company to be running it. You have limited spots in the board of directors. And so you have all your other shareholders whom you have to keep engaged. That's a challenge, but it's doable. And just to touch a word upon the dividend, because it's often not. It is true that one of the ways to keep a broad family engaged is to have a regular dividend. It's the oldest trick in the book, but it works because it creates in a very sort of pragmatic way a link to the company, and just people are going to be interested in the company. Obviously, you have to keep it. You have to balance it. It has to stay reasonable. It has to not hamper the development of the company. So the board of directors, even for private family business, has to do the necessary arbitrage. But it has one advantage, is that I find that sometimes when we have capital allocation discussion on the board of quoted companies, it becomes a very abstract thing. And they say, oh yes, we'll do this and that, and we'll reinvest this and we'll reinvest that, and dividend this year is going to be so much, without a real, feeling to it. And if we have to skip dividend, we'll skip dividend. If we have to reduce it, we'll reduce it because we need it for investment. At the end of the day, on the very long term, a business is worth the free cash flow that it generates. And if you have, wonderful strategies which never generate cash flows, especially then for a non-quoted company, it gets hard to build that report. And having shareholders who are actually with people with whom you have relationship in the context of a family, whose for a part of their livelihood they depend on that dividend, makes it for a very, I think, concrete dialogue on the subject, and an altogether not unhealthy.
Mm-hmm. That resonates very well with some of the ideas that we've heard this afternoon. I don't know, Rika, if you want to add.
I agree. I only have two examples where I'm on the board. One is both listed and family owned. The other is just purely family owned. And indeed, I see it working very well because they have institutionalized, in a way, the family through foundations, where the decisions are kind of made, where dividend policy is set so that there are no annual recurring documents on discussions on how much should we take out of the company. It's kind of relatively fixed. There can be some discussions around the comma, but not really big discussions. And that helps a lot to make the decisions more objective, also in terms of investment decisions, like how much cash is there left, and also how much cash should there be for the dividend. So I really like the fact of organizing it in that way. Also taking away the discussion from generations. And what I particularly liked in another family business I know is that actually you cannot work in the family unless you have first demonstrated that you can have a career outside of the family business. I think for me that is also a very important one in order to motivate to the management teams, because as you move through generations, you start to get external managers in the company, and it should not be by definition someone from the family actually that takes up the key roles. So having family members prove their worth outside of the family businesses, I think is also a very healthy way of making sure they go into long-term, they guarantee long-term success.
Absolutely. So it's really a matter of, if I hear all three of you, it's a matter of insulating the managers from the investors in a sense, which is, again, when we move to the stock markets, one of the themes that has been talked about. And from what I've understood this afternoon is one of the elements that will help in terms of building that longer term strategy or that longer term view, so long as you can create that level of insulation, which in itself is raising a couple of questions, of course, in terms of shareholder control. I'd like to come back to one of the points, Rika, that you mentioned around the public interest and also the element about stakeholdership. You arrived before the session started, and you heard some of the strong positions that were taken about ESG in particular. You're all three in boards where that three-letter word has appeared quite often and is now at the core of some of the strategies that you are looking at. To what extent do you think that that ESG element is contributing to the longer term views? Rika, do you want to start?
Well, I think I'm a big fan of ESG, but not because the term is there. I think we should always think about companies behaving in an ecosystem. We are not somehow isolated operating units where we are not benefiting from everything that's happening around us. We also need the people to work in our companies. These people need to have a good life. We need to use public facilities, and we need, of course, the circumstances around us to be such that we can operate a healthy company and that people can operate in a healthy way in our company. So as House of HR, obviously, I'm completely against greenwashing. And I still remember the discussion with ESG where everyone said, yeah, but you need to have something around the E. And I said, yeah, but in our company, particularly, we don't produce anything. We are not. So we can put something like, okay, as from 2025, we will all drive electric cars. But that's going to be about it. And if you then look at scope 3, actually, driving electric cars doesn't help anything because every year we buy 2,000 cars. So it means that my scope 3 each time gets hit by the 2,000 cars we buy. So someone said, maybe we should go back to diesel cars. And I'm like, yeah, but then this is ridiculous. I mean, either we go for the environment or we don't. And so if it means my scope 3 gets hit, then scope 3 gets hit, but we're going for electric cars if this is what we believe is the right thing to do. So yes, it is an important discussion in the boardroom, but I still feel that you need to have the discussion within the context of your company, within what makes sense for your company. I think particularly House of HR, obviously it makes sense that we put a lot of focus on the S, the social, where we employ as many people from working groups that have a longer distance to the labor market, where we worked with refugees back in 2016, where we try to put people back to work when they come out of prison. So we see really work as an integration into society. So it makes a lot of sense to put the focus on the S, and especially also because it also makes sense from a shareholder perspective, because talent is scarce. We cannot find people, so we should use every talent we have in the market. Same with governance. I think it makes a lot of sense that in terms of governance, we do the right things. In today's day and age, we need to be very transparent about how we manage the company. And again, also for me, governance and independence and how you report. We can put all the legislation around it as you want, but if you have a crook in front of you, they will fool you in any way. So you can have even daily reporting. If you have someone whose intention is to not tell the truth, they will find a way to not tell the truth. So for me, independence, it's in between the ears. And this is where you need to make the right decisions and make sure that you do the right thing. And ESG is part of that.
Mm-hmm. Hilde, just at here, of course, ESG is also at the heart of what you do. There's impressive reporting that has been put in place. Vincent, the responsible is over there and well noted and congratulated for that matter. In terms of the pressures that you're experiencing from the market, how do you see the pressures coming from ESG compared to the shareholder pressure, pure shareholder pressure? And how do you see them being balanced?
Well, at first sight, I don't see any difference because for the first time, during our last general shareholders meeting, we only got questions on climate and our investment. That was the first time. So I don't see any difference. But that said, there was one of the speakers who said stakeholders are for the government.
Yeah.
That was you.
Yeah.
I want to also to have a bit of a philosophical approach to that ESG. I'm in favor, of course. There's no other option now. You must be in favor, especially the younger generation, the generation of my children. They want to work for green companies who respect them, and they want, okay, everything has been said about this. But that ethical layer, that behavior that we expect now from companies started, I think, with corporate social responsibility, governance, directors need to be independent, and now ESG. There must be a limit to that. Ultimately, politicians are responsible for the climate. Of course, we must pay our fair share as companies, and especially as public companies, but there must be a balance. And when I hear that a Dutch court condemns Shell to comply with the Paris agreements on climate change, I have problems with that. So yes, I'm in favor, but not let's say not gold plating. And if there is a fair share between private persons, private companies, and politicians.
Isn't there a question of responsibility also, and allocating the responsibility? Because we're talking about a responsibility to society, but at the same time, legally speaking, at least, your relationship is still entirely with your investors, so to speak. And we know that at European level, this is now being sort of opened up in a sense, especially on the ESG front, which I appreciate is a challenge. Harold, I just on the ESG element, in terms of how you incentivize people to think about within your teams, to think about ESG in the longer term, what is the best way of incentivizing your teams in that respect?
It's a story which is not done in a day. It's really tragic, and the step we're at, and we're coming out of that because the formalism is catching up with us with CSRD. But the step we spent a lot of time on was to work on the substance of ESG, and to find ways of understanding the businesses we were looking at, both in our deal flow and in the portfolio, to see the extent to which they were having a material impact on their environment. And for that we used, the basic notion was to say, all other things remaining equal, if all of our businesses contribute positively to societal issues, we will have a better portfolio. I mean, it's that simple. All other things remaining equal. And so we are looking, when we're looking for businesses whose purpose, the needs they satisfy with their product, with their service, etc., is in a way aligned with the sustainable development goals. And so what we did, and to start with, is to say, okay, when you are diligencing, when you're presenting an investment note, please explain to us the extent to which this business, contributes to fulfilling one of the SDGs. And then you discover that people have a lot of imagination, but we took it as a good sign. At least they're catching on with it. And obviously we had some discussion on to say, well, listen, it's a profitable business. Yes, it contributes to economic growth. Economic growth is one of the SDGs, but that's a little short. And so doing and thinking computers, which is digital. Well, if you go to the sub definitions, it's more challenging. And then so we were pushing the investment team to do that. So the first thing to do in terms of incentivizing is to make them understand how important it is and the way it works. Because actually, it's not easy. People don't, even if we employ a young team, they're very proficient in calculating a DCF. They're very proficient in determining the forces around the business. To actually do analysis on that business and to identify the material issues from an ESG point of view, I mean, it takes some doing. So we're moving along there. But in terms of capital deployment, last year I think about 2/3 of the investments we did in new companies were companies which were, very visibly tied to one of the SDGs. One of them has as a thesis to replace detergents by low carbon impact, low environmental impact detergents. So it's not a plastic bottle you buy at the shop. It's a powder you order by mail, and the first delivery you get a glass powder, and then the following deliveries you get the powder in a recyclable bag, and you just add the water and you add the detergent, and that detergent works as good as the average detergent. That kind of thing, very, very clearly building around that. Now we're being caught up with CSRD, which is in a way all the efforts we're putting in the substance, we will have to put a lot of them into the form, into getting the reporting rights, getting the data, et cetera, et cetera. So, not so happy. But on the other hand, it's sort of, at some point, there's discussions will start. Is this a good idea or not? Well, if you don't want to do it because you think it's the right thing to do it because you must do it, and that's end of discussion, and then you can move forward. So I think CSRD will force us to start looking at our portfolio, or to continue looking at our portfolio and in our deal flow in a way that will make us sensitive. Then the question is, in the long term, I think it's a better portfolio, which will create more value, both on economic and non-economic terms. Do you want, if you make the total pie, not only the economic one, but all the societal one bigger, do you want to incentivize the team in a way that they also reap those benefits? It's a good question, and we're not there yet. But it's a good question. I'm always very weary about specialized incentive schemes. I think it was Charlie Munger that said, show me the incentive plan and I'll show you the outcome. People, they're clever. They have a way of engineering their way to the desired outcome. So you have to be careful what you wish for.
Interesting.
And these independent companies looking at independent directors, they do want to see in remuneration committees that the objectives of the CEOs do hold SDG objectives now. So this is going to also be more prominent, and I'm not so sure it's a good thing, because I think in the end, again, it's like with so many things, you need to do it because you think you should do it, and it drives long-term value of your company and long-term value and the existence of your company. So to ensure that your company is still going to be there 10 years or 20 years from now, and that it's even going to maybe employ your children or your grandchildren, I think if that is the objective of the company, I think you will get a long way. So it should not be because it's in the objective that it gets done. And I think this is the danger of making it so formal that, yes, it has to be in the objective, or I will vote no on the next general shareholders meeting in terms of the nomination of the chairman of the remuneration committee. So I think this is not the way it should be.
But there's an interesting point which comes back out as Southern is gone, but there was an interesting point around the cost of the ESG compliance and the cost in running of the funds that we saw earlier. So that's interesting. I'd like to close the ESG chapter for a minute and come back to some aspects of corporate law and how you address those in the sort of short-termism debate. One of them that made its entry into the corporate governance code, to which both of you contributed, Hilde and Harold, relates to share ownership by independent directors, which is a theme that created some arguments, I should even say, a couple of years ago. We're now 2 or 3 years down the line. Have your views evolved in that respect? And of course, Rika, feel free to jump in on that theme as well. Hilde, do you want to make a move on this? Thomas isn't there. Yeah, no, I appreciate that.
Well, I will try to comment on his point of view. So Thomas Leysen was the chairman of the Belgian Corporate Governance Commission. And until he was the chairman, paying independent directors with shares was like crime. Was considered as really not aligning the interests while making all these independent directors dependent. In a sense, it was that. But Thomas was a huge was in favor of this because he experienced this at several companies. And he wanted to introduce this, that independent directors, that is the best practice, is to pay independent directors partially in shares. And if you don't, you have to explain why. So you see, it's comply or explain. Comply is paying your independent directors partially with shares. Finally, he succeeded in convincing us. I don't know if you are convinced, Harold, but at least at the beginning, I was very skeptical, but I changed. In life, it's what we do. We need to change sometimes, and I don't see why, let's say, stake in a listed company impacts your independent judgment, especially because the law and full of corporate lawyers provides that you can have until 10% of the shares without losing your independence. It's in the, and it's even in the corporate governance group. So if I have 10% of KBC, I'm still independent. Strange, I think. So if I would have, let's say, 0.0 comma of KBC, that would impact my independence. So I evolved, and I think that we have the discussions, you know that, Edmond, at the board level of some are in favor, some are not. I think having a bit of skin in the game can enhance your motivation. You're all humans, after all. And like the management, they have also skin in the game. So yes, I'm in favor.
But it doesn't hurt your long-term view then?
No, that's what can I say? No, definitely not, because you may not sell these shares before the end of your mandate, and you have to wait.
Exactly.
I think 1 year.
1 year.
1 year.
1 year.
So unless you resign from the board.
That's the long-term correction to it.
That's the long-term correction.
Harold.
Yeah. When the discussion was interesting, we had many debates around, does it make the directors independent or not? I personally, I think it's a moot point. In France, it's actually an obligation. If you're a director of a quoted company, you have to have fixed. I think it's 50 shares minimum. That's it. That's in the law, and then there's a practice, and they ask you to have a little more around there. But an amount which is at this stage of individual not insignificant, but at the same time you're not at 10%. No, and I agree with Hilde. It's a thing which is more into administratively. It's not easy to make, because when you pay in shares, that means that you get taxed on, etc., etc. So you have these aspects. In our company, we because of these elements, we did it differently. We said you have to reinvest the proceeds of 1 year of directorship into shares of the company, which comes to the same. And we had some people not being able to do it because they were on other boards or an institution which forbade it from a point of view of compliance. So that's a catch-22 kind of a situation. But I think it's not unhealthy.
I'm not a big fan because I think it's first of all it's very subjective. Like how much is skin in the game? For some people, putting 10,000 money on the table can be skin in the game, but for others, they wouldn't see it or feel it if anything happens. So you would almost have to check what the personal wealth of an independent director is, and then say it needs to be a proportion of that, so that it's sufficiently heard. So I think it's getting very complex in that sense, and it becomes almost like a formality. And then what's the use of another formality? We already have so many. Like quarterly reporting. So, but it's indeed, I'm not a fan. And then maybe why do we then ask auditors to be independent and not have shares in a company? Because that's then the next step. Why shouldn't they own shares? Maybe they should also be aligned with the interests of the company. So they can also, and when you are in a board, you have that possibility. And you need that oversight of, you may have people saying this should be in the report, and maybe we should not take that borrowing now because it will influence our net debt ratio or whatever. And then you have independent board members that say, but the net debt ratio is indeed not what matters. It's what we need to look at in the longer term. So I think it brings a healthy discussion in the board of people that are definitely incentivized by shares and share price, and people that are not, and whose job it should be, if you take the mandate of an independent director, to look especially at the long term of these companies. And in any case, that's how I see my independent mandates. It's to look at, am I doing the right thing for the minority shareholders? And indeed, do I look at the long-term survival of this company in the benefit of all its stakeholders?
So the share ownership for you is not.
No, it doesn't change.
Another element, another feature of corporate law, it is sometimes argued that a dual structure, dual management structure within companies, as opposed to monist structure that we're more familiar with, or that at least in practice we see more often, is a better solution to ensure that longer term view. Hilde, do you have any views on that? I know it's one of Thomas's favorite topics as well, but I'd be keen to hear your views on this as well.
Well, I think at the end of the day, the difference is not that big. You have very successful companies who have a dual governance system, very successful in a monistic dual system. And to be bold on this, I heard once from a very experienced director, and he said, if I am the CEO, I prefer a dual system. Mm-hmm. And if I'm the chairman, I prefer a monistic system. Mm-hmm. So I think it's about information streams. And in monistic systems, the chances are there that stream of information is somewhat more fluent.
Mm-hmm. That's the point that you made earlier, Rika, in conversations as well. Yeah. You were worried about a dual structure.
Yeah. I'm in a board, indeed, in a dual structure, one of the boards I'm in, and there is a lot of the decisions mandated to management, and indeed sometimes you do have the feeling like this was decided, and should this not have been a discussion in a broader kind of forum, and it's kind of an FYI. And I think it always raises the question, like, okay, but whose responsibility is it then in the end if it comes out? I know it's kind of clearly aligned, like what is the responsibility of the managing board and supervisory center. It does indeed raise that question. And I do find, being a CEO myself, that having in the monistic system, so one board, I see the board of directors as a forum in which you openly discuss topics, and where it is not only about here is the information, read it and say yes or no. It is actually also about what do you think about it. We have quite some experienced people around the table, so having that open discussion and being free to discuss and having that in one layer actually makes it a lot more useful. And it's also less time consuming, in my opinion, for management, because I see in the dual system that the management first needs to have the managing board, they come to a decision, they then need to make a report, have the same discussion in an audit committee, in a risk committee, and so on, then have the discussion in the board of, in the supervisory board. It becomes quite a lengthy process to go through the whole process, and so I'm. Yeah, I think it's not the best system.
But you haven't experienced the fact that the supervisory board can take a longer term view.
It's kind of your role in a supervisory board, because it's the only thing you can look at. Because the short-term operating parts is all in the managing board's power. So if you really want to discuss the short term, and I had it a number of times where you raise a topic which is more short term, they say, yeah, but this is not a supervisory board matter, it's a managing board matter, and so the discussion is over. So yeah, in that sense, it has more impact on the long term.
Okay, good to know. Harold.
Yeah, agreed with Hilde's opening point. If you have good people in a good company, anything is better. and if you don't, regardless. That being said, same sort of on comfort with the dual structure, and the think about it, the long term is just a succession of short-term moments, and so if all of those are taken away, there's really not much left to do. I think also that a monist structure is more resilient. If you hit choppy waters, have a board of directors functioning well and really working closely with management and really help steer the company. Whereas if you don't, you have sort of you can create governance tensions just from lack of information.
Yeah.
If I just may add, it's from a theoretical, really theoretical point of view. It's fair to say that originally these some of these dual systems were designed to allow a certain representation of workers at board level. In the Aufsichtsraad, there is a kind of representation. It's also the case in the Nederlandse structuurvernootschap. And that I know is also a theme of Thomas. But I will not further elaborate on this. It can be a theme of a next conference. The representation of workers at board level, is this not in the long-term interest of companies? We have a model of conflict with our workers, so that's in a monistic governance system, that's difficult.
They have it in France, regardless if you have the monist or the dual structure. For instance, a few years you have to have all things together as full-fledged board members, regardless.
And does that sort of warrant for a longer term view, do you think? Because that's again the argument to sort of open up the stakeholder base.
Haven't seen, well, limited experience, so very anecdotal. What it does is that every once in a while there's a discussion, and then the guy from the employee says, it really doesn't happen that way on the work floor. And so you get the fact that management filters the information or condenses the information towards the board of directors because there's just asymmetry. Then all of a sudden you have sort of a little look inside the organization. So it's fun that way.
Yeah, good. I've been prompted by Tom that our time is over, so I'd like to thank all three of you very much for the preparation, but also for sharing your insights with us today and putting some perspective on the short-term, long-term debates that we've had today. Thank you very much. Questions from the audience?
Maybe
if there's any questions.
We have not a lot of time, but maybe it's a few questions.
Yeah, okay, thank you. I was very intrigued by what the two of you said about the very necessary structure for a family firm. And I don't know if you're familiar with this Singapore Family Business Code, but it's essentially the only stewardship code in the world that focuses on family businesses. And it writes down a couple of principles. And I feel like they sort of resonate with things you said. For example, be mindful of succession, but also things like cultivate an ownership mentality, and integrate short-term and long-term perspectives. So very much in theme of what we said today. And I was wondering what you would think of such a code on a Belgian or an European level. So this is like a very informal sort of best practices exchange among controlling shareholders or family firms. Yeah, what's your take on this?
I think from the ones you mentioned, they seem to be, really aligned with and converging with what we said. However, I think from having lived it, the important bit is not so much the principle, it's the fact that you all sat together to write them. And I think as a way of exchanging views and looking at best practices and so on and so forth, wonderful. But to say this is the code that you should abide takes away the ownership of putting it together, of the process of and family ownership and family governance is done one generation at a time. So each generation, and it's a risky moment, has to sit down and come up with the rules of engagement, how they're going to work, how they're going to be dealing with a number of issues. If you tell them this is what you should be thinking about, you're taking that away from them. and it may look nicer because it's been well thought and so on, but the process is super important.
I'm not a fan of regulation in any case.
Like we also have a chapter in the Code de Bourse on family business. It's just not
very used in practice.
Yeah, but one third I read.
At least.
Any other questions? Okay. Tom, then I'll let you conclude.
Yeah, thank you again for your very thoughtful insights on this topic.
I won't attempt to summarize or even give the gist of each presentation. I'm just going to give a handful of reactions to things as they were coming up. Sometimes reactions of this is an interesting thing, even though it's not the main thesis. On the last panel, Harold Boel made a comment, kind of as an offhand comment about competitive markets, which we haven't focused on all that much today, and I think I want to come back to that a few times. We've got really good competitive markets. A lot of what we talked about today isn't so important. It puts a lid on the damage that stock market short-termism can do. So I started off today with 4 questions or 4 issues. It's what really is stock market short-termism, with the thesis that we have too big a notion of what is the time horizon problem in the corporation. Second thing, what the evidence is, and I claim that the evidence is quite mixed. And doesn't deal with some important issues like the partial equilibrium problem of this relates to competition. If we've got a problem over here, it usually creates an incentive for profit making somewhere else in the economy. Cures and costs. Several people have talked in their presentations about there is a potential cure, there is a potential problem, but what are the costs of the problem? And then 4 is explanations to why it's a prominent issue in the polity. Several people have put forward a political economy explanation for some of the things. Presentation. So Xavier talked about executive compensation. Incentives don't always work as clearly as we'd want them to work. Executive compensations become super complex to the point where some of the incentives may end up creating backward bending effects. One comment is this potential endogeneity in some of the incentive compensation schemes. So when we see companies with this plan and good long-term, maybe that this is a company that has to be long-term, and maybe we see this kind of compensation with short-term behavior. Maybe this is a company that really shouldn't be thinking long-term because it doesn't have as many long-term opportunities. Just a question. I don't know what the answer is. In terms of compensation, one thing I'd mentioned in the United States, one of the reasons why compensation is important, we once had, decades, almost a century ago, a very high marginal tax rate of 70%, and it was largely real. And that meant in terms of executive utility, they understood that out of each extra dollar of compensation, at least 70 cents, because we also have a state tax system, was not going to be theirs, as opposed to today where it's 40 cents, that's 60 cents that's going to be theirs, and only 40 cents that's not going to be there. There's a good chance that this has made executive compensation dip in nearly halving of marginal tax rates, made executive compensation much more important. Last panel, similar to Xavier's presentation, share ownership of independent directors, hard to predict what kind of impact it's going to have, meaning that people just have to make a judgment call as to what's going to happen. One of the comments Holger made vis-a-vis Xavier's presentation is that there's going to be some short-termism inherent in the monitoring and corporate governance system. And if we see some short-termism embedded in the executive compensation system, this just might be one of the costs of keeping executives aligned 64% of the time with running the corporation well. Tom presented on controlling shareholders. Different governance systems have different strengths and benefits. Controlling shareholders have some incentives to be long-term. They do have some incentives to be short-term also. And I'm just thinking of an executive at the end of his or her career who's not leaving a legacy on to a next generation of family, who just wants to keep running that enterprise for the last 5 or 6 years, and quite plausibly doesn't want to adopt the new technology that a 35-year-old CEO would be able to do, but that the CEO who's been doing it for 30 years doesn't want to do, but doesn't want to give up the reins of authority. Loyalty shares, starting with Federico. There was a lot of skepticism about loyalty shares in the room, which is in some ways a surprise to me. I thought loyalty shares had a grip on the European imagination, but I learned something. One of the points Mark Roe made it, is that loyalty shares are effectively dual-class shares anyway. The registration component that's needed to make loyalty shares work mechanically means that we've got 2 classes of shares without the potential beneficial structure that attaches to dual class. Sharon, I may be mispronouncing some names. Coalition between true believers and interests in loyalty shares. So controlling shareholders, occasionally governments like the French government, like the idea of loyalty shares if it allows them to maintain control. And then there are people who think that loyalty shares will promote good corporate governance and the long term. I'll report that I think there are 2 Americans in the room. Of the 2 Americans in the room, one of the 2 Americans wondered whether there's a third political economy explanation that loyalty shares, because of the mechanism that essentially disenfranchises foreign institutional investors, or maybe all institutional investors, which may be disproportionately foreign and disproportionately American, has a nice political economy explanation for it, in that we benefit controlling shareholders. We might benefit employees at the controlled firm. In some cases, we benefit the state. And who pays? Well, a slight decrease in influence of foreign American shareholders. What it reminded me of a principle of American taxation that Russell Long, the long-time chair of the taxation committee in the Senate, he said, there's one principle that dominates all tax law in the United States, which is don't tax me, don't tax you, tax that fellow behind the tree. And the effect of loyalty shares, maybe not the intended effect, although since foreigners were excluded at first from eligibility, one wonders, the effect is a lucky effect in that people get the advantage don't face domestic people who are paying the full cost. What else do we have? Zacharias said, and I think this is absolutely accurate, is that for the short-termism problem to be critical, it has to be that the market is not getting it. And there are reasons to understand where and when the market is not getting it. And for the most part, we were talking about the marketplace of investors. And I'd add to that the point that spins off from one of Harold's comments. It's also the marketplace of competition among companies, and that if competition among companies produces the results, it can sometimes produce the results even with a bad corporate governance system in a particular firm, because it's really bad. The firm is going to have difficulty raising capital, and in the long run, will end up disappearing. Related kind of things, a lot of aspects, and this came up in a few different comments. Holden made this point in a couple of different ways. I think I made it in a couple of different ways. There's a package deal in a lot of things, in that just being a public firm, there used to be a lawyer story in the United States that you go public to raise capital, to compensate executives in a way that aligns them better with the company, to compensate employees in a way that aligns them better with the company, and to create an acquisition currency. These are all potentially very large benefits of a company being public, and there are costs associated with it. And we want to be careful about cures and costs. If the cure of a problem seriously impinges upon the main raison d'etre of the public firm, we just want to be really careful about that. Sophie Cools and Anne Lafar, activism can be a cost and a cure of short-termism. One of the things that me is there was a lot of energy around the contradiction between Dutch law and EU law, and this motivated people. I'm not sure we get the same sort of thing in the United States. There are contradictions sometimes between Delaware law and security SEC law, but eventually it works out. Eventually it works out with federal authorities dominating. Buybacks, great discussion between Jesse and Theo. Maybe I consider it a great discussion because it fits so tightly with my prior views. Chuck Schumer. Chuck Schumer is a smart guy. So there are, by my count, there are 5 of my former Harvard Law School students in the room and 3 Harvard Law School colleagues. Schumer went to Harvard Law School around the same time I did. So at least 6 or 8 of us can all positive. Schumer is a very smart guy. So why is he saying this about buybacks, that he hates buybacks? One could be the social policy reason, is that this just resonates with critics of the corporation and gets a few extra votes. There's another closely related reason, which came up in different ways today. Stakeholders. So employees at a firm that has gone through some major buybacks frequently feel this is unjust. I know that I should be getting an extra $30,000 per year. And now what's the firm doing? It's buying back its stock. That money is my money, and they're giving it to stockholders. I think Schumer understands that, and part of the reason he's emphasized it is that this is a non-trivial part of the Democratic Party coalition. And we can put together some other political economy reasons. Here's the employees who have a reason to criticize short-termism, and there are a lot of reasons why that we've already discussed today, why management has a reason to criticize short-termism. Kim, on quarterly reporting, skeptical that quarterly reporting is a major contributor to short-termism. I guess the way I put it is the way I did. 6 months is not the long term. There's good reason to streamline the reporting system. It's a pain for CFOs to put together a quarterly report which doesn't say very much different from what happened in the last quarter. It wouldn't be hard to streamline the quarterly reporting system in the United States to make it much less costly. Probably not a big problem for an S&P 500 firm, but not a trivial problem for very small firms who have to put together the quarterly reports on a regular basis. Last observation, particularly from the last panel, but not just from the last panel. It's important or amazing to me to the extent to which ESG and CSR has taken over discussion of the corporate enterprise, in that it's, I wouldn't say impossible, but extremely difficult to go to a significant corporate conference, even one that doesn't have a name in its title and doesn't have papers explicitly dealing with ESG and corporate governance. It's extremely difficult nowadays not to have the conference turn to ESG and corporate social responsibility, because something has happened where we can't think about too much else other than ESG, CSR, and how the corporate structure affects ESG and CSR. And we did that today also. Last thing, thank Tom for organizing this event.
And also thanks again to all the speakers, discussants, Mark for co-organizing with this for me, Gimv for the very generous financial support, partners of the Jean-Pierre Bloomberg Chair for the very generous financial support for making this possible. And then thanks to all the participants for being there, listening to us and discussing with us. I think I learned a lot. I hope you learned a lot too, and hope to see you again at another event, hopefully sometime soon. Thank you.